What's up guys, I hope everyone's doing good. So today I'll be talking about HYLD. So HYLD is my favorite Canadian listed income ETF. This is a US covered call ETF, basically on the S&P 500, but it has its own twist. I've been wanting to make a video about this one for a while because first of all, it's my biggest holding. It is also my favorite income ETF that is Canadian listed. I just wanted to cover this ETF, and I will also be making a video where I kind of present my top 5 buy and hold forever Canadian ETFs, and this will for sure be in there. Let's get into it. So what is HYLD? So HYLD is Hamilton Enhanced US Covered Call ETF. This one has a yield of around 12 to 13%. What this is basically is covered calls on the S&P 500, but with a little twist. So all of the underlyings of this ETF are Hamilton ETFs, and inside of those Hamilton ETFs, Hamilton decides which stocks they want to hold. So it is very, very close to investing into a straightforward S&P 500 covered call ETF. It's not like they're actually holding the S&P like SPYI or VOO and selling covered calls on them. They're holding a bunch of different underlying stocks inside of their own ETFs, but they're not exactly the holdings of the S&P. So that is the little twist. And on top of that, they do have a little bit of leverage that I'm going to talk about, and why I think this leverage as an income investor is actually a good thing. So as we can see in the highlights section here, the yield is 12.9%, so that is just based on the latest distribution. But like I was saying, HYLD was very expensive when last year we had a big bull market and there was no correction. The yield dropped to 12% flat, and then we had a market correction. But since HYLD is very consistent with their distribution and they're more conservative than aggressive, they're able to maintain their distribution yield, their distribution per share. As HYLD goes down in price, the yield goes up. That's why right now we're closer to 13%. Then it says portfolio of US equities covered call ETFs with overall sector mix broadly similar to the S&P 500. They're not holding exactly the same 500 stocks that are inside the S&P 500. They even have treasury bills and they have bonds. I don't like personally, and I think that also a lot of people don't like, but whatever, like they can't make everyone happy, and they're still doing very good with this ETF. We're going to take a look at the performance later in this video. Another thing is that this one is Canadian hedge, so that just means that this ETFs should not be influenced by the fluctuation of the Canadian and the US dollar. This is very good for stable income and stable compounding, where month after month it's not getting affected by all of those news affecting the price of the US dollar and the Canadian dollar. And as you can see, they also have HYLD.U, which is listed in US dollar. If you guys don't want to be Canadian hedge, it also pays its distributions in US dollars. So that is there for people who would rather go that route. And then it says a good fit for investors who want attractive monthly income, diversified blue chip US equity exposure, a higher yield alternative than just holding the S&P 500 with similar volatility. And then you have enhanced yield and growth potential by adding modest 25% leverage. Basically, when you hold anything that is covered calls and that is not leverage, you're selling calls at a certain strike price, and then if the price of the stock goes over the strike price, you're stuck with the strike price. But since now it is 25% leverage, the stock goes past that strike price, we still have 25% leverage, so it allows the ETF itself to kind of move up a little, like 25% higher, so it's not as uncapped, and it allows at least to follow the market when there's big bull runs and when we see big moves in the market. The fund objective is to provide attractive monthly income and long-term capital appreciation. So a good thing about this one is that you are investing in the total US market, so it is already very diversified and it pays a quote-unquote conservative yield of 12 to 13%. The strike prices that Hamilton is using to sell those covered calls, I assume, are not too aggressive and they have some room for breathing. So we do get that monthly income, and we have some growth also just in the price itself, and in the total returns of HYLD, we do see some very, very good total returns that are basically side to side with the S&P 500. Now, if we look at the total returns in the last month, it's up 2%, the last 3 months 15, 6 months 3, year to date it's up 7.5, in the last 1 year 14%, 3 years 13.4, and since inception 8%. In February of 2024, this is where Hamilton decided to create all of their own ETFs, kick out all of HYLD's holding, and switch to holding their own ETFs with a 0% management fee. They were basically holding income ETFs from all of the other ETF providers. I remember they used to hold like JEPI, JEPQ. It was basically an all-in-one income ETF that was holding all of the popular income ETFs that were available on the US market. Since February 2024, they switched to holding their own ETFs, and the performance have just been so good. Now, when we look at the distributions, another reason why this is my favorite one is because yes, they don't pay a crazy high yield, But since I've been holding them and since they switched to holding their own ETFs as underlyings, they haven't been through a dividend cut. And the dividends are actually slowly increasing. They increase what they can. I watched an interview from the fund manager of HYLD with Adriano from Passive Income Investing. And from what I remember, they were saying that they do have a cushion. So every month they pay you 14.5 cents per share, for example. They still have some few cents that they're actually not paying out and keeping aside in case market goes down. So they're able to be more consistent with their investors. It is possible that they cut out distributions. If the market tanks, obviously they can't do miracles and they can't keep paying as much. In July here, they actually increased their distribution by a little bit, by 1 or 2%. And they kind of do that once a year since I've been holding them. They were paying 14.5 and before that 14.3 for a while. Here 13.3 cents, 13.1 cents. And then in February of 2024, they were paying 13.1 cents. So as you can see, since they switched to holding their own ETFs, the distributions have not been fluctuating a lot and they have been slowly increasing. If we look at the holdings of the fund and the diversification, as we can see, 36% is in tech. We have 10% in healthcare, 7.6% in consumer discretionary, 15% in financials, 9% in communications, industrial 5%, consumer staples 2%, energy 4%, utilities 2%, real estate 4%, materials 4%, and then other we have 2%. It is pretty diversified, but this is still just everything in the US market. Well, like I said, they hold their own ETFs. So they hold SPYI. It's kind of like the NASDAQ / the hottest US stocks. Everything that is very big and that is growing a lot, that has everyone's attention and that has a big market cap is going to be into SPYI. Then QMAX is kind of the NASDAQ again, but it's tech focused. Then we have FMAX, which is financials. LMAX is their healthcare ETF. AMAX is their gold producer. EMAX energy. RMAX is the REITs. And then here's the things I don't like as much because obviously they don't do well in the long run. And as an income investor, I'd rather have my underlyings be growth oriented than being stuff that is kind of sideways or even downwards. So we have those US Treasury bills and then we have a bit of bond, and the weighting of all of this is 125%. So if we just quickly look at all of their holdings, so SMAX is their US equity yield maximizers. They have Oracle, Nvidia, Microsoft, Broadcom, Meta. So like all of those hot stocks on the US market, Visa, Prologis, Exxon, CRM, LLE. So it's not just tech oriented, but it is kind of a NASDAQ basically. Then we have QMAX, which is technology. So I assume is going to be only tech stocks. So yeah, AMD, Palantir, Nvidia. So this is really just big tech stocks in the US market. Then FMAX is financial. So this is all the big financial ones on the US market. Blackstone, Charles Schwab, Citigroup, BlackRock. You guys can go through these, but all of the big financials on the US. Then we have LMAX, which is covered calls on all of the big health stocks on the US market. As you can see, Stryker, Gillen, Boston, Johnson & Johnson, AbbVie, Pfizer. So really all of the big US health. Then AMAX is covered calls on US gold. And then EMAX is their energy from the US market again with covered calls. Pan, Baker, Sivernus, Diamondback, Terra, EQT. Then RMAX is real estate. So you see like it is the S&P 500, but it's still pretty cool that we have some real estate stuff. So some REITs inside of HYLD. Like it's always good to diversify and it helps with different kind of market conditions. Actually, this one has 50% US, 50% CAD. Even more interesting. So we have CBRE, FCR, GRT, WELL, DLR, BEI, REI. All of these big REITs right here are being held inside of RMAX and they're doing those covered calls on them. 1.5% of HBILL, which is their Treasury Bill ETF. They have 80% of SGOV, which is pretty popular, and 20% of TLT, another 1.5% of bonds. This is their holding. Half of it is TLT, 40% VGLT, so the Vanguard long-term treasury, and then EDV Vanguard extended duration treasury, 10% of that. Now for the returns of HYLD, and that's where it becomes pretty interesting, pretty fun to see. So as you can see, HYLD since February of 2024 has been literally side to side with the S&P without covered calls. So as a covered call ETF, as you can see, since HYLD is 25% leverage, when we get a little bull run from the SPY, even though HYLD is capped, that 25% of leverage is going to kind of help pull HYLD up a tiny bit more, counter the fact that it is a covered call ETF and the upside should be capped to a certain point. The total returns of HYLD since Feb of 2024 is 30.97%. The S&P 500 is 32.45%, so a 0.5% difference. So it is very, very close, and I am very happy to see that because a lot of people criticize income investing and say that you're missing out on growth just for income. As we can see here, show this to these people that are talking crap about us. HYLD is able to follow the total returns of the S&P 500. Now, if we compare HYLD to SPYI, as we know, HYLD is 25% leverage, and SPYI has no leverage. SPYI is classic covered call ETFs directly on the S&P 500. As we can see, HYLD is outperforming SPYI, and SPYI is a very popular ETF from NEOS because the 25% leverage and also their underlyings is not exactly the S&P 500. I just like the way it performs. And here, as you can see, the fact that they're using that 25% leverage really helps them. And they're actually outperforming SPYI, which is probably one of the most popular covered call ETF on the S&P 500. And I think a lot of people are sleeping on HYLD, especially Canadian investors. And just pretty cool to see that HYLD outperformed this one. Now, if you compare with YMAX, which is my second favorite ETF, I really like all-in-one ETFs. I like diversification, and I like having a hands-off approach where I can just dump a lot of money and not have to worry about what stock I'm holding, and I can just sleep at night. YMAX has been doing very, very well. And as you can see, HYLD is not too far behind YMAX, despite YMAX having a bigger yield and weekly distribution. So the total return since Feb 2024 for HYLD is 21.97% versus YMAX, which is at 34.68%. So there's about a 2.5 to 3% difference in terms of total returns. HYLD is much more diversified versus YMAX, which is a more concentrated version of the S&P. So obviously it's going to move a lot more and it has more potential for upside, more potential for downside. But as long as the market is doing well, YMAX should do better. But still, HYLD is doing fairly well and able to keep up with a concentrated version of the S&P like YMAX is very impressive to see and very cool to see. Alright, just to finish the video, I just did a little forecast for fun, but you guys are free to play with the numbers. What I like about HYLD is the fact that yes, their yield is lower, but their distributions, as we saw, are very stable. So that allows us to kind of plan for the future and know that as long as we're investing heavily and we're consistent with our investing, our income should grow month after month, and we should benefit as much as possible from our shares being compounded. If we set this to a monthly distribution with drip on, we start with $0 and then we add $2,000 a month, so $24,000 a year. And we set the yield to 12.5%. We don't put any dividend growth or asset growth because I don't care. I just want to see how my income is going to compound. Like I know HYLD is going to grow over time as the market grows, but my point is just to know that I know HYLD will always remain in the 12 to 13% yield. So let's say I do that for 20 years, for example. In 20 years, my annual dividend income will be $264,000. From HYLD, knowing that this one is stable. It's not like YMAX where some weeks you get paid more or less. So this one is going to take more time to build your income. Once you're built up, like month after month, your income is going to be stable. So in the short term, you won't be making as much income as OLT or YMAX, but HYLD is still very interesting. And in my personal opinion, not financial advice, it is my favorite core portfolio position of the moment. I might also add HHIS next to it and YMAX. If we go from 20 years to 5 years, after 5 years, you would have a dividend income of $20,000. So that is about 1.5, 1.8K a month. So that is still very interesting. That is still very good money. Essentially covers 80 to 90% or maybe 100% of people's rent. So still very interesting. And as a core position, like personally, I've seen a lot of growth, but the growth is not very capped because of the 25% leverage. If I invest a lot in HYLD, not only my income is growing, but the value of my portfolio is also slowly growing month after month. And that was it, guys. Hope you guys enjoyed this video. If you're a Canadian investor, let me know in the comments if you were thinking about buying this one, or maybe you already have this one. I'm sure a lot of you guys already do because it's probably one of the most popular covered call ETFs right now for Canadians. There's a lot of other options, but I know this one is very popular in the Canadian income investment community, aside with HHIS and USCL, I believe. Like we do have some other options right now. Even if you're watching from the US, I think this ETF is still very interesting and might still be a good investment if it is available. So that was it for HYLD. Until next time, take care, guys.